In your opinion, what is the thing causing the most concern for people in your country? What is the thing occupying their minds and causing them worry? This is a question that the renowned French research company, Ipsos, continuously asks thousands of people around the world. They summarize the responses in a periodically published report titled, What Worries the World? In the latest edition of this report, specifically the November 2024 version, Ipsos posed this question to over 23,000 people living in 29 countries worldwide, aged between 16 and 74. The responses revealed that the most significant source of concern for people globally is inflation, rising prices, and the increasing cost of living. These are the primary sources of worry and anxiety for people worldwide, which explains why people have been so preoccupied with inflation forecasts in recent years. People are aware that high inflation, growing at a faster rate than their income, erodes their money and reduces their ability to afford living expenses. This is particularly a nightmare for those living paycheck to paycheck. Therefore, one of the most pressing questions on the minds of people in most countries is, where are prices heading? Will they continue to rise, or will they fall? Will 2025 be better than 2024? To answer these questions, we first need to understand the factors driving inflation today, or what is responsible for moving prices, whether upward or downward. This is what we will try to explore together in today's episode. The people who consume the most pasta in the world are the Italians. Pasta is a staple food for Italians, which is why they are very sensitive to its prices. In June 2023, a call for a nationwide strike against buying pasta emerged in Italy. A consumer protection association called Asutenti urged Italians to boycott pasta for a week and leave it untouched on store shelves. Why did this happen? In short, the strike was a desperate attempt to lower pasta prices, which had risen significantly at the time. The strike organizers believed that the price increase was due to the greed of merchants and companies seeking to achieve high profit margins at the expense of consumers. Their proposed solution was to boycott pasta to punish these greedy merchants and companies and force them to lower prices. Ultimately, the pasta strike did not happen, and the Asutenti group canceled the call. However, the question that concerns us here is, was the greed of merchants and companies really the cause of the rise in pasta prices in Italy at that time? Can the greed of merchants or companies raise the price of pasta anywhere in the world, not just in Italy? I will say it. Greedflation, or greed-driven inflation, is one of the most popular theories that has spread among people in an attempt to explain the causes of the significant rise in inflation in recent years, particularly since 2021. Many people are convinced that prices are rising because companies are greedy and are setting high profit margins to earn more. This theory has been promoted by many decision-makers around the world. For example, on January 6, 2024, Turkish President Recep Tayyip Erdogan accused some companies in Turkey of greed in pricing their products, stating that the significant price increases in the Turkish market were due to greedy and opportunistic practices by companies, and that this rise had no real economic basis. Similarly, U.S. President Joe Biden, in his statements, repeatedly tried to direct Americans' growing anger over inflation and rising prices toward companies, accusing them of greed and seeking massive profits at the expense of consumers. At the time, many economists viewed these statements as an attempt by the U.S. president to escape responsibility and avoid blame, whether on himself as the person responsible for the country's economic and fiscal policies or on the Federal Reserve as the body responsible for monetary policy. Interestingly, the American public itself strongly believed in this theory. In June 2023, the Pew Research Center asked a group of Americans in a survey, "Who do you think is the main cause of inflation?" The majority of respondents answered that large companies seeking to maximize profits were the cause of inflation and rising prices. From the perspective of many economists, this answer is inaccurate. The greed of merchants or companies has never caused inflation, neither in the U.S. nor in any other country in the world. I know this point might come as a surprise to many of you, and some of you might think I am defending merchants or companies, but let me explain it to you step by step and start from the beginning. What is inflation, guys? Simply put, and please pay attention to every word, inflation is a sustained increase in the general price level of goods and services in the economy. First, sustained means it is not temporary. Second, this increase is in the general price level in the economy. meaning it is not limited to one product. For example, if the tomato crop in Colombia suddenly fails this season due to an infection that destroys the harvest, tomatoes become scarce in the market, and the price per kilo rises from 8 pesos to 16 pesos. Now, can we call this price increase inflation? No. First, it is a temporary increase, not sustained. The price of tomatoes will drop again once they become available in sufficient quantities in the market. Second, this is not inflation because only the price of tomatoes has risen, while other goods and services remain unaffected by what happened to tomatoes. So, what do we call the rise in tomato prices in this case? We call it a relative price change. The price of tomatoes has changed relative to other goods. For example, before the crisis, tomatoes were 8 pesos, as we said, and potatoes were 4 pesos. This means that before the crisis, 1 kilo of tomatoes was equivalent to 2 kilos of potatoes. When the crisis hit and the price of tomatoes reached 16 pesos, 1 kilo of tomatoes became equivalent to 4 kilos of potatoes, whose price remained unchanged. Only the price of tomatoes changed, so we cannot call this inflation. To call it inflation, the increase must affect goods and services in general. For this reason, economists consider inflation a macroeconomic phenomenon, a phenomenon at the level of the overall economy that causes a decrease in the purchasing power of money held by the population. The money in people's hands buys fewer goods and services compared to before. If people's wages do not increase at the same rate as inflation or the general price level, it means they have become poorer than before. This is why people hate inflation and blame it, which many believe is caused by corporate greed. However, no matter how greedy companies are, they cannot cause inflation, which we defined as a sustained increase in the general price level. This is not because companies are good or respectable, but because they simply do not have the ability to do so. Let's go back to the pasta incident in Italy that I mentioned earlier and test the theory that was popular at the time. If we say that the reason for the significant rise in pasta prices in Italy was corporate greed, then these companies must have had significant pricing power over pasta, meaning they could set prices at their discretion, regardless of costs, and still sell roughly the same quantities. For example, if the fair or natural price of pasta in the market is €1 per kilo, they could sell it the next morning for €2 or €3 without a significant impact on demand. If this were true, it would indeed be greed, injustice, and opportunism, as you might say. But for this to happen, or for these companies to have such absolute pricing power, there must be, in reality, either a monopoly or collusion or both. For example, there must be a single company monopolizing the pasta market, able to set prices at its own discretion. Alternatively, a group of large companies could control the market and collude in pricing. However, if there is no monopoly or significant market concentration in the hands of a group of colluding companies, and the market is open with thousands of companies, including local producers and importers, then there is no room to talk about corporate greed as a cause of rising prices. In such a market, no one can afford to be greedy, or they won't be able to sell their products. The reason is simply competition. If I own a pasta brand and decide to suddenly price it at double the price of competing brands in the market, I will likely end up eating that pasta myself, along with my employees, because I simply won't be able to sell it at double the price of its competitors in the market, no matter what I do. I am constrained by competition on one hand and by the limits of consumers' ability to pay on the other. Take Apple, for example, one of the few companies in the world with significant pricing power over its most important product, the iPhone. Apple prices its product close to the price of its competitor, Samsung's product, because it cannot stray too far from Samsung's pricing without negatively affecting iPhone sales. At that point, people would turn to Samsung, which would offer better value for money. At the same time, Apple's greedy and excessive pricing would make it difficult even for its most loyal customers to afford an iPhone. In short, there are limits to companies' pricing power, even if they are monopolies. A monopolist, no matter how greedy, cannot make the price of a product like pasta several times higher than that of a substitute product like rice. Even if there is a monopoly on pasta that gives companies the ability to increase its price, consumers will simply buy rice instead and leave the pasta on the shelves for the companies to eat themselves or feed to their children. Now, someone might say to me, suppose that the companies monopolizing pasta collude with rice companies. This question, of course, assumes that the rice market allows easy control over pricing. Although there is no monopoly on rice or pasta in almost any country in the world, let's assume this strange scenario where monopolists control both rice and pasta and are responsible for raising their prices due to greed. Here's a question. During the same period when the prices of pasta and rice rose, the prices of many other goods and services, such as healthcare and education, also rose. Were these goods and services affected by the prices of rice and pasta? Or do these sectors also have monopolies and, therefore, greed? In short, corporate greed cannot be considered a cause of inflation, neither in the US, nor in Turkey, nor in Italy, nor anywhere else. Do not confuse cause and effect. The massive profits many companies have recently achieved are not the cause of inflation. They are a result of it. For example, many companies have recently achieved high profits due to the slow pace of wage increases for employees. Prices have risen, and company revenues have increased, so it is natural for them to raise employee wages in parallel. However, there is often a delay in increasing wages, which saves the company costs that translate into profits. This is greed, but it is not what causes the inflation the world is suffering from. It is crucial to understand this because misunderstanding the causes of inflation leads us to propose harmful solutions for ourselves and the economy. For example, if you believe that rising prices are due to corporate greed, the logical solution from your perspective might be for the government to impose price controls. This solution has been tried in many countries worldwide and has repeatedly proven to fail because it often leads to adverse outcomes, including shortages of goods or a decline in their quality. So, what are the real drivers of inflation? I will tell you. The famous American economist and Nobel laureate in economics, Milton Friedman, who was a proponent of the quantity theory of money, said that inflation is always and everywhere a monetary phenomenon. He believed that inflation cannot occur unless the rate of money growth in the economy exceeds the rate of production growth. In short, he argued that the sole cause of inflation is the presence of more money chasing the same amount of goods and services in the economy. Accordingly, the high and unexpected inflation the world is suffering from today can occur either through 1. A negative supply shock that reduces supply while the money supply remains constant. 2. A positive demand shock that increases demand while production remains constant. 3. Or a combination of both. Let me give you a simplified example. In 2024, the economy of a certain country has a money supply of $100 and produces 10 apples. The price of an apple that year is $10. In 2025, a hurricane hits the apple crop, and the supply of apples in the market drops to 5 apples. What happened here is a negative supply shock that caused a decrease in the supply of apples, leading to a rise in the price of an apple from $10 to $20. This is 100% inflation caused by a large amount of money in the economy chasing a smaller amount of goods. After having $100 chasing 10 apples, we now have $100 chasing 5 apples. The crises the world has recently witnessed, such as the COVID-19 pandemic and later the Russian-Ukrainian war, have caused negative supply shocks that have been a significant driver of inflation worldwide, reaching almost everyone in the form of imported inflation. The decline in the global supply of energy, food, and other goods has caused their prices to rise, leading to inflation in many countries around the world. However, there is a very important observation here that you must pay attention to. Negative supply shocks, like those caused by COVID-19 or the Russian-Ukrainian war, no matter how long they last, are by nature temporary, and their effects fade after a period, usually not too long. These shocks cause the prices of some goods, such as gas, and services, such as shipping, to rise. But later these prices fell again, and their inflationary effects disappeared. The 5 apples we lost due to the hurricane, whose absence raised prices, will return in the new season, and with the money supply remaining constant, prices will return to normal. Therefore, to say that negative supply shocks are the cause of the inflation the world is suffering from, these shocks must occur continuously and repeatedly on a large scale. Thankfully, this does not happen. The last major negative supply shock the world experienced was the one caused by the Russian-Ukrainian war, which the world has largely overcome. Therefore, we cannot say that the inflation in a country like Turkey today, which exceeds 40%, is due to the Russian-Ukrainian war. This is inaccurate. We cannot keep saying that the Russian-Ukrainian war is the main cause of inflation in Turkey and many other countries around the world. Today, inflation is primarily driven by demand through positive demand shocks. Before anyone misunderstands, it is essential to clarify that this large and sudden demand is not because people need more than before or because they have a greater desire to consume more goods and services. No, the demand we are talking about here is primarily due to the fact that there is more money in the market than necessary. More money is chasing the same amount of goods and services. In other words, the money supply has increased at a rate higher than the rate of production growth. As you surely know, central banks in most countries are responsible for managing inflation and keeping it under control. Central banks control inflation by managing the money supply using monetary policy tools at their disposal, such as printing money and adjusting interest rates. The U.S. Federal Reserve, the most famous central bank in the world, when it says, for example, that it aims for an inflation rate of 2% in 2025, must have in mind the rate at which production in the economy will grow before determining the amount of money supply it will allow in the economy. For example, let's assume that the Federal Reserve expects the real GDP of the U.S. to grow by 3% this year. If the Federal Reserve decides to increase the money supply by 3%, then the inflation rate in the U.S. during 2025 will be 0. The same amount of money will be chasing the same amount of goods, so the general price level will not change. But if the Federal Reserve says it wants 2% inflation, then it must increase the money supply by 5%. No more, no less. 3% will go toward matching real GDP growth, and 2% will be extra money that will end up in people's hands and push prices up by the 2% the Federal Reserve wants. If we talk in absolute numbers, if real GDP is expected to grow by $200 billion this year, any money the Federal Reserve prints above $200 billion will raise prices. For example, if it prints $1 trillion, $200 billion will offset the impact of real GDP growth, and $800 billion will be reflected in higher prices. At first glance, this might seem simple and straightforward. However, in reality, things are more complicated. Sometimes inflation spirals out of control due to negligence, excessive optimism, or unexpected supply shocks. For instance, if a central bank in Colombia targets an inflation rate of 5%, it must ensure that the increase in the money supply is only 5% higher than real GDP growth. Any increase above this rate will fuel inflation. Here, two scenarios could cause inflation to be higher than 5%. 1. Real GDP grows at a weak rate, say 1%, due to a sudden negative supply shock that reduces production. 2. The government resorts to expansionary fiscal policy, increasing its spending at higher rates, thus increasing the money supply in the economy. This expansionary fiscal policy might aim for the economy to achieve positive nominal growth in the end, regardless of anything, even if this nominal growth is entirely driven by inflation. Sometimes, governments resort to borrowing from their central banks, which print money for them to finance growing budget deficits. The result is an excess of money in the economy, causing inflation. The solution to this dilemma would be 1. To control the money supply and 2. To increase production in the country by encouraging investment and supporting small and medium-sized enterprises. When the U.S. Federal Reserve addresses inflation, it focuses on withdrawing money from the economy. It does this through tools such as reserve requirements and raising interest rates. For this reason, U.S. interest rates have recently risen to record levels. These high rates have had a devastating impact on many countries, especially in developing nations, because rising U.S. interest rates cause 1. Hot money to flow out of developing countries toward the U.S. economy. 2. Developing nations to pay higher interest on their debts, both old and new. Additionally, the rise in U.S. interest rates has been a major factor in the strengthening of the U.S. dollar, which has increased the cost of imports for many countries, especially developing economies that rely heavily on imported goods. All these pressures were expected to ease in 2025 as the Federal Reserve began moving toward lowering interest rates after its significant success in controlling inflation. In its September 2024 meeting, the Federal Reserve, for the first time in 4 years, lowered interest rates by 50 basis points. This was good news for emerging markets, as lower U.S. interest rates would ease the burden of servicing their external debt. However, the joy was short-lived. Less than 2 months after the Federal Reserve's decision, Donald Trump won the U.S. presidential elections against Kamala Harris and returned to the White House on January 20, 2025. This was, of course, happy news for most Americans who voted for him, but it was worrying news for emerging markets. Why? In short, Donald Trump returned to the White House with a problematic economic agenda, which I discussed in an earlier episode titled Trump's America 2025 Plan. You should watch it because it contains important details about what this man intends to do. But to summarize his anticipated policies, we can break them down into 2 key aspects. 1. Expansionary fiscal policy within the U.S. This includes significant tax cuts for individuals and corporations. Increased government spending aimed at stimulating domestic growth. 2. Protectionist trade policy globally. This targets imposing higher tariffs on the U.S.'s key trading partners, particularly China. Trump's domestic fiscal policies, unfortunately, are expected to have negative spillover effects on emerging markets. Here's why. These tax cuts are unfunded, meaning they are not offset by reductions in other spending or increases in revenue elsewhere in the budget. To finance these tax cuts, the U.S. government will need to borrow heavily, leading to higher national debt. When the U.S. Treasury borrows more, it raises global demand for dollar-denominated assets, putting upward pressure on interest rates. This increase in rates will make borrowing more expensive for emerging markets and developing countries. For countries with large dollar-denominated debt, this will increase debt servicing costs, straining their budgets further, make access to new financing even more difficult. Trade war and its potential benefits. Now, let's consider Trump's protectionist trade policies, particularly his stance on China. Suppose Trump fulfills his threats and imposes high tariffs on Chinese imports, effectively blocking over $500 billion worth of Chinese goods from entering the U.S. market. What happens then? Chinese manufacturers will face a massive surplus, as their largest export market, the U.S., becomes largely inaccessible. To manage this surplus, Chinese producers will look to other markets to sell their goods, including developing economies. This surplus is likely to drive down factory prices in China, making Chinese goods cheaper for countries that do not impose trade barriers. For nations like developing economies, this could bring some relief in the form of lower imported inflation. While cheaper Chinese goods might seem like a silver lining, there's a catch: exchange rates. Trump's economic policies are expected to drive the U.S. dollar even higher, especially against the currencies of developing countries. A stronger dollar will increase the cost of imports for these nations, offset the benefits of cheaper Chinese goods, as their own currencies will lose value relative to the dollar. In short, the currency devaluation many developing countries might face could erode any gains they hope to achieve from cheaper imports. So, to wrap up all this analysis, if you want to know where prices are heading in 2025, here are the key things to watch. 1. Monetary and fiscal policy in your country, as these will largely determine domestic inflation. 2. The U.S. Federal Reserve's actions, as changes in interest rates that directly affect global capital flows, the value of the dollar, and borrowing costs. 3. Trump's policies, especially his fiscal expansion and trade measures, as they could have ripple effects on both developed and developing economies. 4. China's economic behavior, as its surplus production could influence global prices, but only if exchange rates and trade barriers align favorably. If you enjoyed this episode, press like, and thank you.